If you want to invest and build wealth, you have to understand the different assets that are available. In today's Investing for Dummies video, I will break down bonds. Welcome to Vigilant MD, Lessons Beyond Residency. Before we begin, it's important for me to mention that I am not a financial advisor and any of the contents of this video should not be viewed as investment advice. Now that I have that out of the way, let's talk about bonds. Bonds are essentially loans that are given to a company or governments from investors. Rather than going to a bank for a loan, companies can issue bonds to raise money from investors with a promise that they will pay the money back with interest over a certain period of time. In general, bonds are considered less riskier than stocks, and investors use them to preserve the money that they have and earn interest. Let's break down all the terminology that is used to describe different kinds of bonds. The investor who buys a bond is called the bond holder. The face value of the bond is called the par value. For example, if a new company issues a bond for $1,000, the par value is $1,000. The par value of most bonds are usually $1,000 with some exceptions. For whatever reason, let's say a particular bond is sold at a higher price than the par value. That is called a premium. So if you buy a bond at $1,100, you bought the bond at a $100 premium. For whatever reason, you are able to buy a bond for cheaper than $1,000, that is called a discount. Regardless of buying at a premium or a discount, the par value is what is used to calculate interest payments and the amount that is returned when the bond matures. The interest that you will earn from holding a bond is called the coupon. The company will usually pay the interest to the investors annually or semi-annually. The length of time at which the original par value of the bond is returned to the investor is called maturity. The date at which the bond will mature and the company will pay back the face value is called the maturity date. Short-term bonds mature in 1 to 3 years. Medium or intermediate-term bonds mature between 2 and 10 years. Long-term bonds usually refer to 30-year treasury bonds, but can be anything that matures after 10 years. Depending on who issues the bond, most bonds are divided into 4 categories. Corporate bonds are issued by companies. In general, companies will issue bonds to raise money when bank interest rates are high, and it's more advantageous for them to issue bonds rather than taking out a loan. Municipal bonds are issued by states and municipalities. Some municipal bonds actually offer tax-free coupon income for investors, and municipal bonds are considered in general to be safer than corporate bonds. Government bonds are issued by a government to raise money for its spending and obligations. For the U.S., government bonds are issued by the U.S. Treasury. U.S. Treasury issued bonds that mature in less than a year are called bills. Those that mature within 1 to 10 years are called notes. Those that mature over 10 years are called bonds. Lastly, agency bonds are issued by government-affiliated organizations other than the U.S. Treasury, and examples of those would be the Small Business Administration or the Federal Housing Administration, Freddie Mac, or Fannie Mae. Some bonds have a call provision. This means that the bond can be paid off earlier than the maturity date if the company chooses to do so. When a company does this, usually they must pay a small premium over the par value to the investors. A company would call its bonds or pay off their investors early if interest rates go down and they feel that they can issue new bonds at a lower rate. For investors, bonds with call options are often attractive because they usually have higher coupon rates. Secured bonds have a specific asset that a company promises to give to the bondholders if the company cannot pay the bond back. This asset is called the collateral. So if the company goes bankrupt, that asset will be transferred to the investors. Collateral can be property, equipment, or even future income streams. Unsecured bonds are not backed by any collateral and are therefore much riskier than secured bonds. Unsecured bonds usually offer higher coupon rates because of this reason. What are the benefits of bonds? Investing in bonds can produce steady income for investors over a period of time. Because bonds are considered to be less riskier than stocks, adding bonds to an investment portfolio can add some diversification and can lower volatility. However, the low returns on bonds also mean that young investors who invest heavily in bonds can miss out on much larger returns from the stock market over a long period of time. What are the risks of bonds? Although bonds are considered to be relatively safe investments, they do have risks. The first risk is a default risk. When an investor buys corporate bonds, there is a possibility that the company may go bankrupt or default on the loan. It is important to examine the financial health and stability of a company before purchasing corporate bonds. Interest rate risk. Let's say that while you are holding a bond, general interest rates in the market go down significantly. The bondholder then faces a prepayment risk because the company will likely choose to pay off that bond early, and then the investor may find themselves having to reinvest in other funds with lower interest rates. On the opposite side of that scenario, if interest rates in the market go up substantially, the investor is now stuck with a bond that is paying below market interest rates until that bond matures. So, can you redeem a bond before maturity? Most bonds are non-redeemable, meaning they can't be cashed out before the bond matures. Some bonds do allow investors to redeem them before maturity after they have been held for a specific period of time, such as 12 months as an example. So usually the investor will have to pay an early redemption penalty for this privilege. If you currently have a bond with terms that you do not like, you don't necessarily have to be stuck with them. That's because you can actually trade bonds in the secondary market at a premium or a discount. Thank you so much for watching my Investing for Dummies series on bonds. If you found this video helpful, please hit the like button and hit the subscribe button down below. See you guys on the next video.